Good evening, friends. Hope you are well and doing fine. Thanks for joining this call to discuss Market Outlook 2024. When we look back, 2023 was an exciting year for us. Markets ended on a positive note, large caps nearly 20% and mid cap and small cap by above 40%. But if you look back the history of Sensex and Nifty for last 8 years, this has been successive 8 years when markets have ended positive, despite 2020 being a COVID year. So it was on the back of some good news flowing out of India in terms of economy. Uh, we remained one of the fastest growing economy despite challenges in the world. And outside economy and market also, we had some kind of achievements when it came to G20 presidency. We landed on moon. And when we talk about sports, there were significant achievements there also. On a diplomatic relationships, also we excelled. And despite Israel war being there, I think it had little impact on us. So on all parameters, India had a decent year as far as 2023 is concerned. Now, as we begin 2024 on a positive note, minus last couple of days when there was some kind of volatility, but markets have been fairly optimistic. But when we look ahead of us on 2024, there are certain events that we thought we should bring to your attention. Importantly, 50% of world population will be going through election this year. Of course, what matters to us is India, the largest democracy in the world by population, as well as US, which is the largest democracy by economic size. Besides this, there are still reports coming whether there will be some kind of slowdown in US, because of which there can be some reduction in interest rates in second half. So how this will affect India going forward and how we will respond to those kind of challenges, that will become very interesting. So we have today with us Chirag Setalvad, head of equities. Uh, Chirag does not need any further introduction. He has been with us for more than 2 decades, and when it comes to small and mid caps, is a name to reckon with. But he almost oversees more than 3.5 lakh crores of equity as far as equity AUM is concerned for us, and comes with a wealth of experience. And he's going to take us through what does he believe in 2024. Very recently, we released our annual edition of the yearbook 2024, uh, which is our like a fourth edition this time, and we have outlined our thoughts there. We have circulated those thoughts or the book over email to all the investors. Hope you have perused that. And nonetheless, Chirag will be taking us through the presentation, the key slides, because it's quite a detailed presentation. So Chirag will just take us through the key slides which he thinks should bring to your attention, can influence the outcome of 2024. So as we begin or we start our march in the Amrit Kal, which has actually begun on a positive note, let us hear from Chirag. What does he feel about economy, markets, and what can investors expect going forward? Over to you, Chirag.
The presentation really has a couple of parts to it. The first is covering what has transpired last year. So it just puts in last year into perspective. And then, of course, we will touch upon global economies, the US, Europe, China, and India, and how these have performed last year and how they are possibly going to perform going forward as well. And then lastly, we'll touch briefly upon the overall market and where do we see valuations, large cap, mid cap, small cap sectors, and so on. So I think all of that put together will take about half an hour of our time. So let me start with the year gone by. And this is interesting because last year was a year of reversal. All the things which did terribly in 2022 recovered very smartly in 2023. So if you look at Bitcoin, which was a disastrous performance in 2022, recovered very sharply and came back smartly in 2023 and gave a return of more than 150%. starkly. Now, this doesn't always happen just in a 1 year time frame. It just so happens that this is the case at the moment. But contrarian investing certainly has a lot of value. And you can see here that things which have done badly last year have done well this year. Nifty is the one exception to this. Nifty has actually bucked the trend and given a positive return 3 years in a row. In fact, in the last 10 years, the Nifty has given a positive return in 8 out of 10 years. And I think despite a few asset classes, most asset classes did give positive returns. There are a few which give negative returns, things like oil and the agri index, but most asset classes did manage to give a positive return. And it's interesting how over a 10-year period, equities has been the best asset class to be in, right? Whether it's Nifty, whether it's MSCI World, whether it's MSCI Europe, far outperformed any other asset class. Gold, agri, metals, treasury, oil have all been laggards when compared to equities. So certainly equities, I think 2 points we want to make here. One is, of course, that equities is a fantastic long-term asset class to be in, and it's the asset class which has consistently done well. And the second, as we pointed out earlier, that there is a lot of mean reversion and there is value in contrarian investing, and shown very starkly here that how pretty much everything which did badly last year has recovered very sharply this year. Moving specifically to equity markets, last year the domination was, or the outperformance really was more in developed markets compared to emerging markets. So we had markets like NASDAQ and Japan, Taiwan, which did extremely well last year. So compared to a 10% return for emerging markets, developed markets did almost twice of that, giving a 20+% return. And, developed markets have done far better than emerging markets. Again, you see Nifty is an outlier, which has done well consistently for 3 years in a row, as opposed to other markets which have gone up, down, and back up again. And as I said, Nifty has now given a positive return in 9 out of 10 years. On the other hand, commodities have not done well. Last year was a year in which, if you look across commodities, returns have been, I think, except for iron ore and the precious metal index driven by gold, pretty much most other commodities have given a negative return. And what I think is even more interesting, and this is partly driven by the global slowdown, this is partly driven by China reopening being disappointing. But even more interesting is when you look at it from a 10-year time frame. Metals have been, and commodities in general have been big underperformers. The agri index has given a 2% return compounded over 10 years, metal index 4%, and the precious metal index, precious metal 4%, and overall metal index about 2%. So commodities really have been a big underperformer for a long period of time. And because of the correction in commodities last year, this has certainly helped the profitability of companies, and we'll talk about this later on in the presentation. But earnings growth has certainly been supported by a correction in commodity prices. So that was last year in snapshot, a great year for equities, sharp recovery in a lot of asset classes, and commodities being a significant laggard is how I would summarize it. We'll talk briefly on the economy, global economy, and then move to Indian economy, and then lastly to markets. So let me start with the global economy piece. I think last year global growth has surprised positively. At the beginning of the year, we started out expecting that growth would be closer to 2.5, 2.7%, and that's for the overall global economy, and that ended at closer to 3%. So about a 2.2% surprise. And the surprise in global growth was really driven by the US. At the beginning of the year, what you see in the blue line here at the bottom, the US growth was expected to be close to 1%. And by the end of the year, it turned out to be closer to 2.5%. So really almost a 1%, 1.5% surprise in terms of growth in the US. And the US is almost 25% of global GDP. So really the surprise in global growth has been driven by the surprise in US growth. So growth has been better than expected. So the hard landing didn't transpire. And it seems like we're heading to a soft landing at the moment, at least. And at the same time, we saw that inflation came down sharply, right? Whether it's in the US, whether it's in UK, Eurozone, Japan, I think we are all aware of this. Interest rates have come down sharply. And as a result, over a period of time, inflation has come down sharply. And of course, over a period of time, interest rates will also start following that. When you look at what drove the surprise in the US, because the US is the chief driver of surprise in global growth. It's really been a combination of factors. The first is that private consumption held up much better than most people anticipated. And there were two, three reasons behind that. One is that the labor market has been quite resilient. So a lot of people left the labor force during COVID and not everybody returned. So I think that has been one key driver. The second was we saw that over the last sort of 10, 12 years, we've seen a big change in US household net worth, and that has increased by almost 150% of GDP. So a combination of buoyant real estate prices and buoyant financial assets has meant that the net worth of households has risen quite considerably, and that aids things in a downturn. So despite the issues around COVID, because of the tightness in the labor market and because of household net worth going up, and also because of accumulated savings which took place, all of these sort of supported the US economy better than what people anticipated. The second bit, so the first part was really consumption held up far better than anticipated. The second was the fiscal deficit actually rose quite sharply from what was 4% to almost 6-7% in 23. So the government spent a lot more money. While there was monetary tightening, there was fiscal easing that took place, and that has helped the US economy. So these are the couple of key factors which drove the better than expected performance in the United States. When you go to Europe, sorry, we have one more slide on the US, which is, there is going to be a slowdown next year that is coming down. So as that excess saving, which the government put into the pockets of people during COVID times, that is wearing off, and that will have an impact on consumption. The second is, as inflation comes off, real rates turn positive. And when that happens, there tends to be a slowdown in consumption as well. And lastly, the US housing sector, we are already seeing some correction in terms of building permits and housing starts and so on. So you have to keep in mind that there's a delayed impact of interest rates. US mortgages are typically 30-year fixed rate mortgages. And as a result, it takes time for people to roll over to higher rates and for that impact to come into real estate. But that will happen. So the lag effect of interest rates, the fact that real yields would be higher and their accumulated savings have come down, all of these are expected to result in a slowdown in US growth. And I think what is interesting in this is that most of the world is still struggling to grow. US will grow from 2.5% to possibly 1.5%. Europe is struggling to grow in absolute terms. China growth at 5.2% is a lot of question marks in terms of validity and accuracy of those numbers. And here we have India, which is growing quite nicely at 6.5% and expected to continue at that trajectory. So really India stands out. That's why and we'll talk about this later on, why the Indian story is so robust is because our growth stands sort of head and shoulders above what you see elsewhere. But let us quickly move past US to China. And I think I won't go through it point by point, but I think the key takeaway here is that China growth disappointed. There was an expectation that post-COVID, and they had a very harsh lockdown, that things would come back very, very sharply, and they did not. We saw consumption come back quickly, but real estate continues to be a laggard. And real estate really drives investments. Most of the investments in China happen at a state level, at a state government level, not at a central level. And almost half of funding at the state level comes from real estate sales. So when real estate slows down, it impacts spending quite significantly. So real estate continues to be weak, exports continue to be weak, consumption came back, and the government tried to spend as much as they could in effort to support the economy. And a number of stimulus measures were announced. But even as incremental data keeps coming in from China, a lot of question marks in terms of how China growth sort of sustain even at 4.5%, 5.5%. And right now, at least a fair degree of weakness being seen in real estate. In the last 10 years, China has spent almost 40% of GDP in terms of investments, and that's a very large number, and you can't continue at that pace. So unless consumption picks up, the Chinese economy is likely to slow down. You cannot continue with this excess level of spending on infrastructure and investments. So China remains an area of concern from a global growth standpoint. The last piece is really, before we get to India, is on Europe. And I think most people are aware that Europe it's been a very difficult year, We've seen gas prices jump sharply, and even after correcting, they're still 50% higher than where gas prices were pre-COVID. Consumer sentiments are weak. Of course, the Ukraine war has made that sentiment even weaker. And China recovery has been modest, and China is the second largest trading partner to the Eurozone. So all of these have contributed to the European recovery being the weakest, right? So US surprised positively, China was a mixed bag, and Europe was really a disappointment. And across the board, whether it's on industrial, housing, consumption, all those the excess savings continue to remain high. So higher excess savings and actually a low unemployment rate may mean that Europe may actually surprise positively next year. This year, the big surprise, or last year, the big surprise was US, China being a question mark, and Europe being a disappointment. Next year, it might actually be that Europe on sort of very low expectations, and a low base as well, may actually surprise things positively. So weak at the moment in Europe, but with the potential to possibly surprise going forward. So with that, we come to the Indian story, which is an incredibly robust one. So we'll first we'll speak less about global Gyan and a little bit more in terms of specifics. But let's just touch upon a little bit of the broad big picture numbers first, very quickly. So India, it's remarkable the journey we're on. We have gone from the 10th largest economy from a GDP standpoint to expected to be the 4th largest, and so on, increasingly becoming important. So India can't be ignored, right? At our scale, we'll be the 4th largest GDP economy. We'll be the 3rd or 4th largest stock market. So India has gone very much from the fringes to the center of the debate. Look at contribution of India's growth in the last sort of 5-6 years. India has contributed to 12-13% of overall global growth. That number will increase to almost 20%, 17% to be exact. So India's contribution to global growth is becoming more meaningful. Most economies are slowing down. India continues to grow at its between the 6 and 7% rate, which means we are becoming much more relevant and important in the global context. And here we've shown you GDP growth, real GDP growth at 6% compared to what we see in the rest of the world, which is far lower. And really, the Indian narrative has been strong across the board, right? So it's not only growth. So growth is one part of the picture. Growth has been far better than what is witnessed outside of India. The second is that inflation has been in India much more benign. So unlike the US, which has faced issues regarding the labor force, or unlike Europe, which faces issues regarding labor rigidity or gas prices and so on and so forth, India has no structural issue at this point that we can tell on the inflation side. And inflation is by and large close to the range in which the RBI would like it to be. So, this is why India stands out. India's growth is impressive. India's inflation is manageable. India's political environment seems to be stable, or the expectation is that it will be stable. So this slide really talks, the two engines to growth, two parts of the economy, consumption and investment. So we just briefly wanted to touch on both. So I won't go through the consumption piece too much. We all know that how India's demographic is extremely strong and so on. We're a very young country, etc. So it provides great long-term tailwinds, right? Right now we are seeing a slowdown in consumption. So far what has happened is urban has been strong, rural has been weak. Now we are seeing urban slowing down a little bit because of the impact of weakness in the IT sector, because of Indian accumulated savings coming down and so on. Rural has been weak, but it's expected to improve. So it's a mixed picture right now. For long-term consumption is a very, very positive story. But in the near term, urban has been strong, which will slow down a bit. Rural has been weak because of inflation, which will hopefully pick up a bit. So some elements slowing down, some elements picking up, but the long-term story from a consumption standpoint remains extremely positive. When you look at capex, really this has been the highlight for the last few years and continues to be a highlight. Capex is roughly broken up into three parts: government capex, real estate capex, which is household capex, and that you see in the real estate sector, and it's visible across cities. New launches have picked up very nicely. New sales are doing well. In particular cities, prices have also started to move up. So as a result, we are seeing some improvement on the household capex, which is in real estate, picking up as well. And the last bit is private sector capex. So private sector capex has been weak for many years, but you can see that number of projects being announced are rising. So first, and it's a lagged impact. First, you announce the projects, and then of course you implement them. Project announcements have improved materially. And I think over a period of time, private capex will also likely to improve. Of course, it's supported by things like China Plus One, which we think is very real, and we can see the impact of that across sectors in chemicals, in auto, in textiles, etc. Make in India, lower corporate tax rate, all of that is helping the environment for capex. So just to summarize this, government capex is strong, was strong, and is expected to remain strong. Household capex is expected to improve as the real estate sector picks up. And of course, having a RERA in place is a big positive because it puts in place a positive regulatory framework. And private sector capex, which has been dull for many years, we think that will pick up, and we've seen an improvement in announcements, and it should be followed by an actual pickup in spending as well. So that's on capex. I'm not going to run through the manufacturing slide just in the interest of time, but I think this is a big theme that is playing out in India. It is a combination of China Plus One, which is real and gaining momentum. It is also because of Make in India policies and campaigns put in. So I think this is a story which will play out quite well over the next couple of years. So that gave a little bit of India's story over a longer term. We also wanted to briefly touch upon the India story in the near term and what it looks like from that perspective. So let us first look at, so these are what we call high frequency indicators. So it just shows you how things are on a short term basis. And even here, you can see across the board that, things are doing quite well, whether it's from a services, construction. Having said that, we just wanted to point out that there are some things which are pushing up growth, but there will also be some things which will be headwinds. So let us run through those. So some of the factors which are likely to impinge possibly on growth next year. We alluded to this earlier, that urban consumption has been quite robust, but that should slow down a little bit, right? This weakness in IT, the slowing down of pent-up demand, all of that should result in urban consumption slowing down to some extent. The second is capex. While overall capex, that theme remains in place, you have to keep in mind that the government is targeting fiscal consolidation of roughly 1.5% over the next 2 years. And if you have fiscal consolidation, then you will see some degree of slowdown in capex, or you can't see capex certainly accelerating from here. I think you have to keep that in mind. From a near-term standpoint as well, capex will slow a little bit as you get into the pre-election time period because of restrictions as a result of elections taking place. So government capex, while at a state level, I think will continue to be quite robust. At a central level, they may come down a little bit. And I think what can help this out is if disinvestment picks up. Because if you want fiscal consolidation, but you want to continue to spend, then you need to have disinvestment taking place. And disinvestment has been a disappointment for many years. I think this year might actually be the year in which we deliver, because markets have gone up and the market cap of PSU stocks, whether it's banks, whether it is defense, whether it is utilities, whether it is logistics, have all moved very sharply. So there is a potential to raise 20, 30, 40,000 crores if the government does it quickly and sensibly. But government spending, I think, which has run at a very robust pace, will slow down a little bit because of this consolidation. But I don't think it's a factor to worry about too much, because it will still be reasonably healthy. And last point, of course, from a slowdown standpoint is is the lagged impact of monetary policy. As inflation comes down, real rates tend to expand, and that could have an impact on consumption as well. Things which can improve the outlook, rural sector has been a big laggard. And as inflation rises, the rural individual is impacted to the greatest extent. And of course, vice versa. As inflation comes down, they see the greatest benefit. So we are seeing inflation moderating, and hence we think that rural can potentially have a better outlook next year. Inflation is better, food grain prices are okay, input prices in terms of seeds and fertilizers is coming down. And of course, the elections tend to give a stimulus to the rural economy. So I think rural can look a little bit better. State government will continue to be spending in a robust fashion. That is the expectation. And lastly, we spoke about private capex earlier as well, that private sector has an opportunity or ability to pick up quite well. So I think I've taken a lot of time on the economy. So let's get into the more exciting part, which is the stock market. It's been a fantastic year across the board: large cap, mid cap, small cap. Large caps get forgotten because mid caps and small caps have done so well. But before we get into that, let's talk about let's give it a longer term lens first. India's market cap has risen to about close to 4% of global GDP. And India's market cap in ranking terms, we are now number 5. And if you think that China and Hong Kong should be looked at one, because 80% of Hong Kong listings are based on mainland companies, then we're really number 4. So India's, we are certainly not by any stretch a fringe market, as we are the 4th largest. I think that's an impressive achievement. When you look at the bottom chart, it just shows you how many larger companies are available both for Indian and foreign investors. Number of billion-dollar companies has gone from over a 10-year period from 150 to it's almost tripled to 500 odd. So a lot more large-size companies for investors, both local and global, to invest in. That makes India a more attractive destination. In the last 10 years, it's interesting to see what has driven performance. So you can see which sectors it's really been banks, IT, which have been big movers. Real estate is a small sector relatively, and FMCG performing in line, and the metals and pharma being amongst the laggards over the last 10 years. So that gives some sense in terms of what happened over a longer term time frame. And when you look at it from a near term perspective, you can see how we've had an incredible performance last 3 years, with a minor dip in 22 in small caps, but really extremely strong performance. And post that, and of course, it's been very broad based. It's been large cap is dominated by mid cap, small cap, but also large caps have certainly participated. And across the board, sectors have given sort of strong returns. And you can see that in this slide how sectoral performance has behaved. Because of this rally, now things, where do valuations stand? The Nifty is now trading at about 20 odd times 1 year forward from a PE standpoint. And that's at about a 10% premium to its long-term average. And when you think about the India story being so robust, it easier to sort of find and pick stocks. So large caps our perspective is that large cap valuations continue to remain sensible. We have on the chart on the bottom right showed how sector valuations are stacking up. So private banks are at a discount to their long-term average. Auto, oil and gas, pharma are close to their averages, and then IT and utilities have now moved to a meaningful premium compared to their last 10-year P multiple. So large cap valuations continue to be okay. Mid caps, the story is a little bit different because mid caps have seen a very, very sharp rally, and now valuations are at about a 40% premium to their 10-year average. And of course, mid caps have been big outperformers. And if you correct that 20-25% over a 6-7 year period, then returns come down by 3%. So I think we have to temper down our return expectations in the mid cap, small cap category. I'm still a big believer in these segments from a long-term standpoint, but from a 3-5 year standpoint, I think we should be a little bit more careful. We should bring down our return expectations, considering the strong performance that we've seen last year. The caveat to this, I think, is we forget the importance of time in all of this. So if you look at it in another way, if mid caps 6 months later were to, let's say, correct by 10% from here as an argument, then 10%. So in a year, earnings grow 15-20%. So in 6 months, earnings growth is roughly 7-10%. So if the market were to correct 10%, in 6 months and 6 months elapse, then that's another 7-10% time correction. So a 10% lower market 6 months from now is equivalent to almost a sort of 20% correction. So I don't think that, even though the market mid caps do look a little bit expensive today, I think when you, like I said, I think we have to reduce our expectations of returns from a near term, but I continue to remain constructive from a longer term standpoint. Small cap is a similar story to mid cap in the sense that it again is at a 30% premium. Relative premium to large caps is also expanding. So again, I think in small caps we need to be careful. We've seen a very, very sharp rally. We've seen significant inflows. So if you look at the bottom left-hand chart, almost 40% of inflows this year has come into small and mid caps. The number of folios in small caps, which used to be 4-5 million, less folios than large cap folios, that has now crossed large cap. So a lot of retail interest, a lot of institutional interest, a lot of foreign interest, all of that combined. So I think again we need to tread carefully in small cap and mid cap both, but the large cap universe continues to be reasonably priced. We wanted to briefly touch upon during the yearbook how did capital markets behave. So just a few points to make. We've obviously seen very, very strong flows. So if you look at the middle chart on the right-hand side, last year foreigners and domestics put in $20 billion each. Right, last year foreigners were sellers to the extent of about $17 billion. So from a minus 17, it's moved to a plus 20. Domestics were buyers last year of 20. The market. So the importance of the domestic investor has also increased quite sharply. Mutual fund ownership, which used to be 5-6%, as recently as 2018, has now gone to 8-9%. So, and if you look at it as a percentage of free float, it will be double that number, almost 16-17%. So aggregate book. So that as a result, it'll tend to be stickier. So I think this brings down volatility to some extent, right? But markets will correct regardless of whether you have these positive structural factors. But it's worth pointing out that there is support coming in from SIPs, support coming in from cash. IPOs, etc. While they did pick up last year, they were not, at least in the excluding the SME segment, IPOs were still lower than peak levels. This just to point out how the retail participation has jumped sharply. You can see the number of demat accounts has risen, has more than almost sort of tripled since 2019, from 40 million to 120 odd million. We are also seeing a lot of speculation clearly in this market. Derivative to cash volumes is 400 times in India, right? I think 95% of derivative volumes are option volumes on the index, and the average holding period is 30 minutes, right? So a lot of speculation clearly taking place. And this is something which I think you have to be a little bit careful of. When you look at, I think one of the interesting things we observed, and that's why we've included it into this annual yearbook, is how we saw the SME part of the market explode, right? So while we think that mid cap and small cap have done well, the SME segment of the market has really done even better. And I think that's something we have to be extremely careful about. Market cap in the SME segment would have gone almost 10, 15 times in the last 3 years. So BSE from 2,000 to 30,000 crores, NSE from 6,000 to 50,000 crores. And the IPOs on the SME segment have done unbelievably well. Average oversubscription is 100 times, right? Average listing gain is 35, 40%. So imagine in the middle of the class, a C grade average performer is giving you a 40% return. So I think there is a lot of excess which is getting built into the SME segment. So I would advise investors to be very careful on that part of the market. So before we get into global valuations, I'll just summarize the India bit. Large cap 10% premium, I think is okay, and we continue to remain positive on the large cap valuations. Mid cap and small cap at 30-40% premium does mean that we have to temper down our return expectations. But from a longer term standpoint, I still think there is a lot of alpha generation in that category. But in the near term, I think we should be a little bit careful. Global valuations in the US, actually valuations are at a bit of a premium to the long-term average. And a lot of that is actually driven by NASDAQ and by technology. But outside of technology, really the US market is closer to average. Europe trades below average. Emerging markets also trade below average. The US, the big outperformer, of course, has been the NASDAQ, and 5 stocks have contributed to 50% of return in the NASDAQ. And these 5 stocks have added $4 trillion of market cap. That's equal to India's market cap, right? So really these 4 companies have become mega caps. So when you look at global valuations a little bit in that way, that is, if you strip out technology, actually US valuations are close to average. Europe is actually below average. China is also below average, and India's I think large caps at least are in line. So it's not that global valuations are a big source of concern outside of specific areas of technology. I'm not going to get into sectoral outlook, though we have several slides which we have included here on the sector. But if there are specific questions, we can answer that. But let me just broadly cover without getting into the specific slides. From a sector standpoint, financial services, from a valuation standpoint, I should say, financial services valuations continue to be sensible. Oil and gas and metal valuations are still okay. But otherwise, valuations are in other segments have moved up, certainly. In pharma and IT, valuations are above average. Actually, in FM, the other sector where valuations are still okay is in consumer. They look expensive on an absolute basis, but keep in mind that consumer stocks have been flat for almost 2 years. So the relative, that's a summary on the sector bit. So let me just end the presentation. We have taken a fair amount of time. So I want to leave 15-20 minutes for Q&A. But I think the summary is this. Yes, Indian markets have done extremely well. We will always have periods of consolidation and correction. But if you're a long-term investor in India, it's an incredible journey, because this is an economy which is growing at 6-7%. You add another 6-7% from an inflation standpoint, or 5-6% from an inflation standpoint. It's an economy which is growing at 12-13%. Over a longer period of time, corporate earnings will reflect GDP growth, and the stock market will reflect corporate earnings. So over an extended time frame, seeing those kind of returns, I think are reasonable, of 12-14%. Now, in the near term, the market can always shake, right? We've had a fantastic journey. There are uncertainties out there from global growth. There are uncertainties out there from, what will happen in Israel, and so on and so forth. And markets have moved sharply, and valuations are a little bit expensive. So therefore, you should be a little bit careful, right? But I think the long-term outlook remains extremely positive. But I think from a near-term standpoint, you should be careful. You should look to invest predominantly through SIPs. You should focus a little bit more on the large cap categories where valuations are a little bit better. Be a little bit careful of small cap and mid cap. See, small cap and mid caps have rallied very sharply, and post that, their allocation in our portfolios has moved up because of mark-to-market gains. So you should be a little bit careful of that. So I think that's it from my standpoint. With that, I will hand it over to Ashok for questions. Thank you.
So I think thank you, Chirag, for your time. Thank you, everybody.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.